Hello, my name is Matt Bisanz, and I'm a bank regulatory partner with Mayer Brown. I'm excited to join you today for this micro talk on the SEC's new climate disclosure regulation. While the regulation itself is literally hundreds of pages in length, I'm going to focus on the changes to Regulation SX, which is the financial statement disclosures. In a former career, I was a public accountant, and so I have an appreciation for the financial statement disclosures, even though for many of our listeners, I'm sure the SK disclosures are going to be more important or more substantive. But let's dive right in. So the SX disclosure section has some significant revisions from the proposal. First, it does away with all of the proposed financial impact metrics. This is all of the disaggregated information about the impact of climate-related conditions on the consolidated financial statements of a public company. The rule says that basically the SEC thought this would be too burdensome and that there were other ways to provide sufficient information to investors without requiring the generation of all of these metrics. One of the pieces of information the SEC proposes or says will be required of public companies is expenditure metrics. And this is a more concrete form of what was in the proposal. It effectively requires a company to report the actually recorded costs associated with climate-related events. And for this case, it is total recorded expenditures on an expensed or capitalized basis. So no projections, no estimations, no cost allocation. It's actually an entire line item based on the occurrence of severe weather events or other natural conditions. This is more narrowly focused on disclosure items that are already captured for accounting purposes and probably is a good change from the high degree of speculation that was present in the proposal. Although it still does require a fair bit of analysis to understand what are costs or expenses that were caused as a result of severe weather events, that kind of mapping still may not be built into all of the accounting systems. Also, while these line items must be disclosed in the aggregate, they do need to be tied back to the financial statements. Further, the final rules add a requirement for companies to disclose the aggregate amounts of carbon offsets and renewable energy credits that have been expensed, capitalized, or otherwise suffered losses. This relates to the idea that these are values or attributes that investors may care about. It also, I think, is a bit of the flavor of the month that RECs are in vogue, just like greenhouse gases were in vogue when the proposal came out. The final rules helpfully implement a de minimis threshold of $100,000 or $500,000, depending on income or balance sheet statement items for these expenditure and carbon items. Additionally, there will be reporting requirements for financial estimates and assumptions that are impacted by severe weather events. This has a materiality qualifier and also should be a fairly narrow category because of the relative nature of these types of estimates in the accounting system. Companies also will be required to provide contextual information about their expenditure metrics and other parts of their climate financial reports. This is more akin to what's covered in SK, and so it shouldn't be too difficult. The final rules omit discussion of the opportunities or say that companies are not required to talk about opportunities, and there isn't even a voluntary process for them to do so. All of the required disclosures, the expenditure metrics, the contextual information, and the estimates and assumptions disclosures will be in the financial statements, which means they'll be subject to audit by the independent public accounting firm and also subject to the internal control over financial reporting. This will be subject also to the auditing standards of PCAOB, and even if not covered by IFRS, it must be included in the IFRS audit. So overall, only a few items are included, but each of them goes very deep into the financial statements by requiring companies to identify line items that are impacted by climate change and map and disclose those in their financial statements. Please stay tuned for future episodes on the SEC's reporting rule, and also tune into our free writings blog that will have this content as well as much more on the final rule. Thank you and have a great day.